We see risk appetite getting a boost all over the place. Oil prices are now dropping, but even before that, we saw stock futures substantially higher for Europe. US futures look a little higher. Asia's had a really good session. Your perspective?
Yeah, so I think, throughout the conflict, we have seen kind of this dip buying mentality on good news, and overall markets have been relatively resilient, which is indicative of when the conflict is over, there's a healthy appetite to buy stocks. And events over the past 24 hours have clearly been a positive. Iran is now signalling, publicly a willingness to negotiate, which, has caught some off guard because it didn't look like they had a huge incentive to, with oil prices in triple digits. So yesterday may, potentially have marked the bottom in markets for the conflict, and it makes sense for stocks to rally, but there's still quite a few hurdles for the market to clear. We still don't know what Israel's response are going to be. Are they going to stop activities in the region? We still, don't know exactly what Iran's demands are. If they're the ones from last week, then there's a huge negotiating gap between them and the US. Then also we need to figure out what's actually going to happen with the Strait of Hormuz, because it doesn't necessarily seem like a massive priority from the US to get that reopened.
And that's the bit that makes it perhaps a surprise that we have oil reacting as well. We're just at 100 on Brent now. Are you surprised, though, that the FX moves are where things are relatively muted?
Yeah, I'm not necessarily too surprised about the FX reaction. I think we saw, from yesterday, we saw the kind of this mechanical, sell the dollar move where, risk appetite picked up and kind of undoing some of the move that was seen throughout the conflict. But to your point about, Hormuz potentially still being closed, this is of note for the FX market particularly, because if people start trading relative growth aspects, as they have been doing, then all those countries which are net energy importers, we've got the Eurozone, we've got the UK, it's not necessarily the all clear from them. And as we've kind of seen, there is potential lasting damage for energy infrastructure, even if they do get Hormuz reopened. So therefore, we may not see central banks be as reflexive as equities are. And, even if, we do see some rate bets scaled back, markets aren't really trading relative interest rates. It's all about the growth outlook. And the US stands to still outperform relative to the rest of the world.
OK, thinking about the growth outlook, this has become the most recent preoccupation of bond markets, hasn't it? So it's not necessarily about the inflation fears as it was in weeks past. It's now seems to be about growth. Is that how we interpret the fact that we see lots of bond buying, sovereign debt in Europe in particular this morning, and yields coming down? The Italian 10-year yield down by 14 basis points this morning. Yeah,
it definitely makes sense that there will be some, buying of fixed income products. US yields are lower, and I think for the US it's the big story because it kind of could get them back on potentially cutting rates. But as you mentioned, the market has been increasingly focused on the growth outlook. I think what the market now needs to see is actually where does Brent settle. If it still settles markedly above pre-conflict levels, that still does provide a growth headwind for the rest of the world, and as such we may see some relative outperformance in US paper relative to other markets, and that's what we need to watch going forward.
Yeah, your colleague Ven Ram arguing oil above $120 a barrel would herald that next leg of bond selling. Adam, thanks for joining us. That's Adam Linton from Bloomberg's Markets Live team.